Well, hello, Michael. Welcome to the program. It's great to have you back.
Thank you, Simon. How are you?
I'm really well. Still a strange time, but it makes for interesting conversation.
Yeah, absolutely. It's definitely a unique period.
Let's start off with the RBA came out this week for the first time giving an optimistic outlook and a pessimistic outlook. What did you make of that?
Look, I think what's going on there is that they, like everybody else, are really struggling to, I guess, really determine the speed and magnitude of restrictions, easings of government. Bearing in mind Australia, each state's going to go at potentially a different pace and have different parameters. So trying to actually forecast what that actually means for the economy, how sustainable these easing will be. So are we going to get any second waves or clusters of COVID infections? But I think the other, most probably larger challenge is trying to estimate behavioural changes of consumers and what the new normal may or may not look like. So if you think about it, if consumers become more risk averse for longer or retain risk aversion for longer and they spend less or they travel less, that's going to undermine things like inflation, GDP and employment growth forecasts. So I think in recognition of that, and I suppose the third thing they've got to try and work out too is how governments and central banks wind back stimulus packages, because I think we all recognise that a lot of the government stimulus packages are unsustainable from a fiscal perspective. So you're already seeing a bit of increasing noise in Australia regarding job seeker and job keeper packages and how long they should remain or whether they need changing. So I think for the RBA or any forecasts, you've also got to think, well, if the government starts to remove or reduce some of these stimulus packages, what's that going to look like and how does that impact? So I think they're being prudent to say, well, we've got a baseline forecast for inflation, GDP, employment, but yeah, there's an optimistic one if things go back to the new normal, whatever that looks like, faster. But alternatively, if things drag for longer, that's a more pessimistic. What does that look like?
And to some degree, I guess what we're saying is volatility is here for a while, because these are guesses that everyone's making and behavioural based guesses.
Oh, look, they certainly are. And I think one of the other sort of things related to that are the heightened geopolitical risks at the moment. So initially, we were looking at US-China relations, and a lot of the theme last year and late in 2018 was US-China trade wars. But we're now seeing some interesting developments with Australia and China, and threats of an 80% tariff on Australian barley, and also I think 4 meat processors have sort of been put on hold from their ability to export to China. So that you've got the US election in 6 months. So you throw into the mix these geopolitical things going on, and you'd hate to be a forecaster at the moment.
One question I've got for you that it's got me baffled at the moment is the stock markets have bounced back amazingly. And when I look at what we've just said there around the downside risk, to me, it seems like it's bounced back a little bit falsely.
Well, I'm most probably the worst picker of share markets in the world, I think. I don't, having a self-managed super fund, I don't think I'm a great one to talk on this. But I was reading this morning, the S&P 500 in the US has rallied 34% now from its 23rd of March lows. I guess there's a few things to bear in mind. We did see the sharpest and quickest sell-off of equities, I think, certainly in living memory, or certainly in any period I've studied. So we did have a period in late March where not just equities, but even if you look at the Aussie dollar, got down to 55 cents, that were, by any historical measure, incredibly oversold, most probably at record oversold levels. So I guess you would always have to expect some retracement. The other thing is that at that point, I don't think markets were forecasting the extent of both central bank actions, and not just cutting rates, but quantitative easing, bond buying programs, other liquidity measures, and also the extent of fiscal stimulus and government economic packages. So I think that's been a factor. The other thing that I think has happened is that people have started looking at things like COVID infection rates, death rates, the dreaded curve that we all talk about, you know, what's happening with that. And there have been some encouraging signs in a number of countries, particularly places like Australia and New Zealand, but also parts of Asia. And I suppose when you've put all those things together, the market was always most probably going to have a bounce. I'm a bit like you. I think it now is, I would call it a little bit overly optimistic. And if you look at Australia, the average price earnings ratio is still around that 15.5, 16 times. So it's not far from average. It's certainly well below the pre-COVID levels when we're above 20. But I would think that you've got heightened earnings risk now. And it's interesting that if you look at the trough of the Australian equity market, the PEs, average PEs bottomed at about 8.5 at the worst of the GFC. So we're a long way from those levels. So I'm a bit like you, but I've got to tell you, equity markets beat to a different drum than, say, the bond markets. And
absolutely, it's not. I'm not an expert in that space at all. So what about on the foreign exchange side, the FX side? What's sort of keeping you awake there?
Well, if you look at option volatility, it's certainly retreated quite sharply from where it got in late March, which is no surprise because markets were oversold, and we've seen the Aussie recover from 55 cents back to 65. In fact, we've been up to about 65.70. So again, and if you look at things, cross rates like the Aussie Euro, it's recovered all of its sell-off. It sort of sold off nearly 20% and it's bounced back nearly 20%. So volatility has come off quite a lot. It's still above its longer term average, but again, we've seen a bit more of risk appetite globally. So people have been a bit more comfortable with not just equities, but the Aussie dollar is seen as a bit of a proxy for risk in China. So we've certainly seen the Aussie most probably back to more normal sort of trading ranges. I would say though that again, I think in the short term, the Aussie dollar appreciation appears limited. So I think the Aussie dollar is going to struggle around 66.5 to 66.80, which was a key support last year if we do get back up there. But having said that, it seems well supported the last few times around 63.70 and 62.5 and 60 cents, I think are going to be good support levels. A few of the Aussie trading banks are sort of have a fair value model at the moment in the Aussie of around 62 cents. And I think the Aussie will remain with some short-term downside bias. But I think longer term, if markets continue to pick up into 2021 and COVID-related issues sort of subside, it's not hard to see the Aussie dollar back above 70 cents. But I think I'd say its risk down is most probably more in the back end of Q2 and early Q3. But certainly, again, I think for anybody in the FX market, the best strategy is if you're an importer is to use short-term rallies in the Aussie just to chip away, a month here and there. I think exporters should be using dips. We may well have seen the low on the Aussie. In fact, I think the only way we won't have seen the low is you'd need a pretty catastrophic second wave, I think, of COVID. Otherwise, it looks like we've seen the lows. I think they've got to use those dips and the risk for exporters is that come next year, if things do continue to progress or they find a vaccine, the Aussie dollar will be potentially, a little bit higher, quite a bit higher, could be 10% higher than where we are now.
Yep.
Certainly against the US dollar. What
about on the commodity side? What are you seeing?
Commodities continue to be a bit of a mixed bag, I guess. So certainly oil's been a interesting commodity to watch. I never thought I'd see it trade in negative territory, but that just shows you the current markets. I think if you look at oil, it clearly sold off dramatically, and that's having quite an impact on inflation. And we've seen I think the US last night, their inflation numbers were the worst or the lowest since the Depression. So I think -0.4 and -0.8 between core inflation in the US. So clearly declining oil prices have had a key impact on that. But we're seeing lower forecasts now for US oil output, a bit of a slowdown in the growth of global stockpiles and cuts to production by the OPEC alliance nations, including in some countries even larger cuts. So we've seen oil prices stabilise and actually start to rally again. So West Texas oil's back around the mid $25 a barrel after getting down, well, if you forget the negative, the night it went negative, it certainly was trading in the low teens for a while. So that's I guess markets are starting to get a bit more comfortable there. Iron ore's certainly been a lot stronger than expected, and that's been a key boost for the Aussie dollar. And funnily enough, we had a record trade surplus in March in Australia, despite the lack of tourism and lower foreign students. So iron ore, I think Chinese demand has been stronger, and there's also been some supply issues, particularly from key area suppliers such as Brazil. But there are signs of weakness elsewhere. So an example is Kobe Steel operating mills in Japan. They're about 20 to 30% lower capacity than last year. And that's weak demand from the auto sector, which has obviously been hit hard. So again, there's, like with all these things, there's some potentially conflicting data. Base metals have started to recover a little bit again from sharp falls. So, and some of the inventory starting to be drawn down in copper. So LME, I think inventories of copper fell about 5%, the most since November 2018. So we're starting to see a few more withdrawals, but mainly centred in Asia, suggesting demand is improving a little bit. Gold prices remain firm as a flight to quality and safe haven asset. And sort of food commodities, any food that's sort of related to oil, ethanol based like sugar and corn have been pretty weak. There's been disruption to some of the meat commodities due to meat processing supply shutdowns in the US and Canada and other areas. We've even seen one issue of COVID in a meat processor in Victoria. So food commodities have been, some have fared better than others, but again, very much a mixed bag.
And what about on the interest rate side? What are you forecasting there?
Oh, look, I think there's no doubt that in Australia, the RBA will be on hold for a prolonged period of time at 0.25%. I think most probably more relevant is the what the yield curve does and what bond yields do. So we're seeing at the moment the RBA is sort of targeting that 3-year bond sort of area and looking to try and have that bond yield flat to the cash rate around 25 basis points through bond buying programs. The longer end of the curve, I think you'll see the 10-year Australian bond rate trade maybe between 0.7 and 1%, most probably for the next 6 to 12 months. I think the thing to watch there is any winding back of that bond buying program, or if the RBA start to not target that 3-year bond rate around 0.25%, would start to see that curve potentially steepen. The other longer term call out is as you get record levels of government debt, at some point will people command a bit more of a risk premium to hold bonds? Now at the moment, because people want flight to quality, that's not going to happen. But it is something longer term to keep an eye out, because I do think at some point investors may want a slightly higher risk premium given the escalating levels of global government debt. So you might see curves steepen, but again, I think that's maybe a 2021 story, not 2020. But overall, global bond yields will remain historically low and supported by central banks, and I think it's going to be quite a long time before you start to see monetary policy being tightened.
Understand. And any key watch outs for treasurers then that you think they should be keeping their eyes on?
Well, I guess we've mentioned the geopolitical risks are certainly one thing with China and the US and the US election. I think one of the challenges for Treasury is going to be interpreting data. So if you look at Australian data to date, the reasons I think the Aussie dollar is quite comfortable in equities is we haven't really had a piece of data yet that's hit you between the eyes. Like, we've got employment data tomorrow, and that's the forecast there is unemployment will jump above 8%, and there's most probably, there may be job losses of 575,000, which are horrendous numbers. But the reality is they would have, or could be a lot worse in the absence of government stimulus. So it's going to be difficult to actually really decipher economic data, because there are a lot of distortions through what the central banks and governments are doing. And so we're not necessarily comparing like with like. If you look at retail sales in March for Australia, they were a record jump of over 8%. But if you strip out the supermarkets, they were actually pretty horrendous.
Right.
But the line level was strong. The March employment data showed employment growth, but most of that was done pre the shutdowns or restrictions. Even, you look at the March trade surplus being a record in Australia. So there's been actually a lot of really strong numbers, but we haven't really seen the true extent of what's happened in April and what's going to continue to happen with restrictions and changed human behaviours. So I think for treasurers, trying to interpret the maze of economic data and really decipher it and revise forecasts on the back of it's going to be a major challenge.
Michael, it's been great to have you again. It's a fascinating time to be talking Treasury and to be in Treasury for the listeners out there. So make the most of it, because you'll look back on this as a big one, I think.
I agree with that 100%. And always great to catch up.
Speak soon, Michael.
Pleasure.